Hello, savvy savers, and welcome back to Frugally Rich, your go-to channel for making the most out of every dollar. If you're new here, hit that subscribe button and join our community of smart spenders, wise savers, and savvy investors. Today, we're diving into the world of tech investments, guided by none other than the Oracle of Omaha himself, Warren Buffett. With a net worth of over $100 billion, Buffett is one of the most successful investors of all time. But did you know that one tech giant, Apple, plays a significant role in his investment strategy? That's right. Today we're going to unlock the secrets behind Buffett's tech investments and take a closer look at how Apple contributes to his massive dividend income. So if you're ready to learn from one of the greatest, grab your notebook and let's dive in. Warren Buffett, the chairman and CEO of Berkshire Hathaway, is known for his value investing strategy. He looks for undervalued companies with strong fundamentals, and he's a big fan of dividends. But Buffett doesn't just look for any company that pays dividends. He looks for companies that have consistently paid and grown their dividends over time. This is because consistent dividend payments can be a sign of a company's financial stability and its commitment to returning value to shareholders. Buffett also prefers companies that have a competitive advantage or moat, which allows them to maintain their profitability and continue paying dividends even in tough economic times. Now, you might be wondering, what does this have to do with tech companies, and more specifically, Apple? Well, let's dive deeper to find out. Apple, the tech giant known for its innovative products and loyal customer base, has been a key player in the tech industry for decades. From the groundbreaking iPhone to the sleek MacBook, Apple's products have revolutionized the way we live and work. But Apple isn't just known for its products, it's also known for its strong financial performance. Despite the competitive nature of the tech industry, Apple has managed to maintain consistent growth and profitability over the years. And here's where it gets interesting for investors. Apple has a history of paying dividends to its shareholders. In fact, since it started paying dividends in 2012, Apple has consistently increased its dividend payout every year. This consistent dividend growth is one of the reasons why Warren Buffett, a known fan of dividend-paying companies, has invested heavily in Apple. But how exactly does Apple contribute to Buffett's dividend income? Let's find out. Warren Buffett's investment company, Berkshire Hathaway, owns a significant number of Apple shares. In fact, as of our last check, Berkshire Hathaway owns over 5% of Apple, making it one of Buffett's largest holdings. Now, remember those dividends we talked about earlier? As a shareholder, Buffett receives a portion of Apple's profits in the form of dividends. And given the size of his stake in Apple, these dividends add up to a substantial amount. In 2020 alone, Apple paid out dividends of 82 cents per share per quarter. If you do the math, that's over $3.28 per share for the year. Now, multiply that by the hundreds of millions of shares owned by Berkshire Hathaway, and you can see how Apple contributes significantly to Buffett's annual dividend income. But it's not just about the money. Buffett's investment in Apple also shows his confidence in the tech giant's future growth and profitability. And for individual investors, it's a reminder of the potential benefits of investing in solid dividend-paying companies like Apple. So, what can we, as individual investors, learn from Warren Buffett's investment in Apple? Let's break it down. Lesson 1. Look for consistency. Buffett invests in companies that have a history of consistently paying and growing their dividends. This can be a sign of financial stability and a commitment to shareholders. Lesson 2. Seek competitive advantages. Companies with a moat or competitive advantage are more likely to maintain their profitability and continue paying dividends, even in tough economic times. Lesson 3. Diversify. Buffett's dividend income comes from a variety of sectors, from tech to banking to consumer goods. Diversification can help manage risk and increase potential returns. And finally, Lesson 4. Be patient. Investing is a long-term game. It takes time to see the results of your investment decisions. So be patient, stay the course, and remember that the journey to financial success is a marathon, not a sprint. These are just a few of the lessons we can learn from Warren Buffett's investment in Apple. By applying these lessons, you too can start building your own investment portfolio and generate a steady income stream. Let's take a look at a real-life example that brings our discussion to life. Imagine you're an investor who 20 years ago decided to put $1,000 into Apple stock. You believed in the company's vision and saw potential in their innovative products. Fast forward to today, and your investment would have grown exponentially. According to Kiplinger, despite the market's ups and downs, Apple's long-term performance has been nothing short of impressive. This story isn't just about the numbers, it's about the power of long-term investing and the potential returns from investing in a solid, dividend-paying company like Apple. It's a testament to Warren Buffett's investment strategy and a reminder of why he's one of the world's most successful investors. Now let's take a look at another real-life example that highlights the power of compound growth. Now let's consider a different scenario. This time, you're an investor who decided to invest a larger sum, say $10,000, in Apple 20 years ago. You saw the potential in Apple's innovative products and believed in the company's future growth. Fast forward to today, and your investment would have grown significantly. According to US News, your investment in Apple would have grown at a compound annual growth rate of 39.2%. Significantly outperforming the S&P 500's 10.1% CAGR during the same period. This case study highlights the power of compound growth when investing in high-performing companies. It's a testament to the potential for exponential growth and the importance of patience in investing. These real-life examples bring to life the lessons we can learn from Warren Buffett's investment in Apple. By understanding these principles, you too can start building your own investment portfolio and generate a steady income stream. And there you have it, a deep dive into Warren Buffett's tech investment strategy, with a spotlight on how Apple contributes to his massive dividend income. We've covered a lot today, from understanding dividends to exploring Buffett's approach and the key lessons we can learn from it. We've also looked at real-life case studies that bring these concepts to life. These stories remind us that investing is a journey. It takes time, patience, and a willingness to learn. But with the right strategy and mindset, you too can start earning a steady income from dividends, just like Warren Buffett. Remember, the journey to financial success starts with a single step. So take that step today. We believe in you, and we're here to help you every step of the way. If you've enjoyed this video, then you will absolutely love our video about the secret to Warren Buffett's 7 investment stocks. This video unveils Warren's top stocks, and you will not want to miss it. There's a link to this video at the end. Before we wrap up, we have a small request. If you found this video helpful, please give it a thumbs up and share it with your friends. It helps us reach more people and continue providing valuable content like this. And if you haven't already, hit that subscribe button and turn on notifications. Here at Frugally Rich, we're all about helping you make the most out of every dollar. And trust us, you don't want to miss what we have in store. Finally, we'd love to hear from you. Have any questions or comments? Want to share your own investing success story? Leave a comment below. We read every single one, and your feedback helps us create better content for you. Thanks for watching, and remember, the journey to financial success is a marathon, not a sprint. So take that first step today. Until next time, keep investing, keep learning, and keep growing. This is Frugally Rich, signing off.